Kita akan berbincang bersama dengan Country Lead Corporate Ratings Southeast Asia S&P Global Ratings, Xavier Jean. How are you, Xavier?
Very well, thank you very much.
A pleasure to have you in CNBC Indonesia.
Thank you for having me.
Your overall evaluations about economic condition in Indonesia and how does it affect the view of S&P Global about corporate ratings in Indonesia?
Sure, so maybe I should start by setting the context of the GDP growth that we have for the country. For the past decade, it's been hovering around 5%. We don't think that's going to change for 2024 through the end of the probable first mandate. So very supportive, I would say, economic conditions. Now, something that we have observed in Indonesia corporate sector is over the past 15 years, companies have benefited less and less from the GDP growth. So it's becoming more difficult for them to grow their revenues and grow their profits because of a lot of factors, including there's a lot of competition out there. So it's not because economic growth is good that the corporate sector is going to continue doing very well.
But this year's economic growth expectation is around 5%.
Correct.
But we know that in the global condition has still facing a lot of uncertainties, a lot of challenge. The era higher for longer is still here to stay. The commodity prices are still soaring and rising. The tension in geopoliticals are still uprising. How do you see this will affect the Indonesia's economy resiliency and so corporate fundamentals?
So the corporate fundamentals, so if I take them one by one, interest rates, higher for longer, that's going to impact the corporate sector across Indonesia, especially those that are asset intensive, so actually borrow quite a lot of debt in order to do their operations. So infrastructure companies, for example, construction companies, but also those segments that require short-term funding. So you can think about retailing, you can think about trading, wholesaling. All these small sectors, they're actually reliant on funding costs to be low in order to succeed. Geopolitics for now, it's not affecting the market significantly because Indonesia has managed to kind of side away a bit from the China-US difficulties. The bigger focus, I think, for Indonesian corporate sector is really the slowdown in the consumer sentiment. Consumers are not willing to spend as much as they were a couple of years back.
That was the data that we received just a couple of months ago, and then there's a trend on that about on the first quarter of 2024. And how do you see this as a challenge for Indonesian corporates to thriving in this, challenging times?
I think it's very difficult for them because more companies are going after the same customers. So what that means is they have to spend a lot more money in order to get those customers, a lot more advertising expenses. They have to do a lot more discounts. So the demand is there. It's just much more difficult for them to acquire it. And that's really the result of this massive growth that we saw between 2010 and 2019. The market potential of Indonesia is huge, but a lot of companies identified that potential and came into the market. So now you have a lot of oversupply in many sectors.
Oversupply and very, very extreme competition between competitors of anyone who wants to tap into to this populations of 270 million people. So from your point of view, especially on the corporate ratings and then the corporate issuing fund, have you seen an increase in the corporate fund issuing for corporate bonds? And how does it compare to the one before the pre-pandemics when the liquidities are accessed?
So pre-pandemic, effectively, to summarize, every company of a certain size that wanted to raise money could actually raise money. They could raise money in the USD bond market, they could raise money in the domestic bond market, they could raise money in bank loans. So there was very little selectivity of the capital providers.
Pre-pandemic.
Pre-pandemic. And then the pandemic hit. So for 2 or 3 years, what you've seen is a big shift in the willingness of the banks and in the willingness of the bond market to extend credit indiscriminately. So what we are seeing today is in the domestic bank market, funds are available to be lent, but banks are very selective. So they only lend to the biggest companies, the biggest SOEs, the more profitable firms, and so on. In the US dollar bond market, you see very few companies in Indonesia being able to access the capital markets. Only the large companies like Pertamina, PLN, some of those big SOEs in the mining sector or energy sector.
And they are also SOEs, not only big corporations.
So. Exactly. So you have this risk-off sentiment in the US dollar bond market that's still lingering on, and I think that's going to last probably another 12 to 24 months. And in the domestic bank market, banks have the ability to lend, and I think they will continue to do that. But they are still very selective as well. So funding is more difficult to obtain and is more expensive.
And how do you see this trend will persist going forward? For how long the situations will happen, and what are the end of the tunnel situation that will actually changing the situations to get better eventually?
So I think the first one is interest rates coming down in the US.
Okay.
So when we did this analysis recently about US dollar issuance in Indonesia versus interest rates, what we've seen is when interest rates start to come down, there is more willingness from investors to look at emerging markets. Our base case is interest rates are going to come down by about 250 basis points within the next 2 or 3 years.
On the Fed fund rate?
Yes. So around 250 basis points, so at 2.5% Fed fund rate.
So when they reach around 3%?
When they reach around 3%. But investors, they always anticipate. So I would say around mid-2025 to late 2025, you could see more interest from US investors to come to Indonesia. But interest rates are an absolute must for funding to become more available. It's not only about economic growth.
Okay. From the S&P views and analysis, do you have an expectation when the Federal Reserve finally will cut its rates? So because there's a lot of consensus, we see that we thought it would be around this half one, and it postponed again to half two, and there's this worst case scenario where the Fed fund rate will not doing any cut rate for this year. Xavier.
So our base case is still 25 basis points in December this year. So very, very small cuts, and then about 125 basis points, so 3 to 4 cuts in 2025, and then another 3 to 4 cuts in 2026 to get back to this 2.5% Fed rate.
So they're not getting back again to the 0-ish%?
Not anytime soon, no. That's not our expectation.
So there will
unless there is a major crisis.
Oh, wow. That's a great finding. So there will be new normal in this Fed fund rate levels that are created because of all of the situations that happen globally.
Absolutely, that's our expectations. And because companies now will still have to pay something for their money, for their borrowings, is going to change, as we were discussing earlier, a lot of the business models.
Okay.
Those low margin business models that rely a lot on debt to operate will have a lot of difficulties.
Okay, because the new normal is around 3% or
2 to 3%, probably 3%. For the Fed fund rate.
Okay, before move on about asking you about the ratings downgrades or upgrade that your institutions have been doing, Xavier, I need to know when the new normal happened, and then the Fed fund rate will stay around 2 or until 3%. And that is actually quite an anomaly rather than the one they had around 0%. What happened to the central bank's regulations around the world?
So I think it's not really a new normal. What happened before was too extreme. The fact that for many years you really didn't borrow for very much cost was actually the anomaly.
Okay.
If you look at the past 25 years, the average fund rate is actually around 3.5%. So the fact that it was at 0 for an extensive period of time was the bizarre thing in a way.
So was okay, that was a nice
now, what is the problem is companies, they get used to very low cost of funding. And it's a bit dangerous for them because you are not incentivized to improve your operations, you are not incentivized to rethink your business model because your cost of funding is so little and your margin is so predictable. So it's still going to be a big change for them because now they have to reinvent the way they operate, reinvent the way they improve their margins, reinvent the customers that they are tapping into, reinvent their business models to take into account those higher costs of operation.
Well, thank you. Really, really great insights, Xavier. And moving on to your institution's rating upgrade or downgrade, during this 2024, we are now in May, so we have gone through 4 months, a very, very turbulent 4 months for the economy globally. Any rating upgrade or downgrade that you have done and the reasons why?
So if I take the Asia-Pacific perspective first, and I like to set the perspective also to help compare and give some context around that. So during COVID, the 3 years of COVID, 20 to 22, we took rating actions on about 40% of our rated portfolio. So that's quite a lot. Before COVID, the average was around 15 to 20%. So we've taken twice as many rating actions during the COVID period, which was very difficult for companies, than during a more normal cycle. Because we've taken so many rating actions, now the credit quality has come down across Asia-Pacific and in Indonesia as well. And as a result, the turbulence that we have observed since the beginning of the year is not really affecting those companies because they've already been weakened by the COVID situation. You still have a few pockets of risks here and there. So real estate in Indonesia is a sector that's facing difficulties because they have a lot of debt that is coming due and it's difficult to refinance. The commodity sectors has been very also challenged because commodity prices went up significantly during COVID.
But is it good? Is it good for them?
It was great at the time, but now they've come down at the time where they have to reposition their business model and do more investment. So when you think about it, you have less profit and you have to do more spending.
On CapEx,
and capital spending, exactly. Because the mining sector is, we call it a depletion sector. Once you have mined 1 ton of coal, you don't have it anymore. It's mined. So you have to replenish that base on an ongoing basis. It's a bit like real estate. It's a bit like oil and gas. Manufacturing, you can operate your manufacturing for 25 years without having to do much more CapEx. But for those sectors, you have less profit and more spending.